Your HSA isn't just for medical bills. It's actually 3 different tax deductions hiding in one account, and most people are completely ignoring it. I'm talking about the triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses? Also tax-free. That's literally impossible anywhere else in the tax code. Not in a 401k, not in a Roth IRA, nowhere. And here's the kicker. Most people are leaving $150,000 to $300,000 on the table over their lifetime by not treating their HSA as a stealth retirement account. Let me break down exactly how to use this, because this is insider knowledge most CPAs don't even explain properly. First, let's talk about the deduction itself. If you're self-employed or own an LLC, you can contribute up to $4,150 per year if you're self-only coverage, or $8,300 if you have family coverage. In 2024, these numbers go up annually for inflation. Everything you contribute reduces your AGI, adjusted gross income. That means it's lowering your taxable income dollar for dollar. If you're in the 32% tax bracket, that's $328 in tax savings on a $4,150 contribution, just from the deduction alone. But here's where it gets interesting. Most people think that's it. They contribute, they use the money for medical expenses, and they move on. Wrong. You know what I do, and what every sophisticated business owner should do? I keep receipts. I contribute the maximum. I pay my medical expenses out of pocket, and I invest the HSA funds in low-cost index funds, or ETFs, inside the account. Now we're talking about tax advantage number 2, tax-free growth. Let's say you're 35 years old. You contribute $4,150 per year for the next 30 years until retirement. You invest that money conservatively at 7% annual returns, which is below historical market averages. Do you know what that account is worth at age 65? $597,000. And here's the beautiful part. Every single dollar of that $597,000 grew tax-free. You didn't pay capital gains tax, you didn't pay dividend tax, you didn't file Form 8949, nothing. It just compounds, untouched. Try doing that in a taxable brokerage account. Compare that to a regular investment account with the same $4,150 annual contribution. At 7% returns with 25% capital gains taxes, you'd end up with approximately $380,000 instead of $597,000. That's $217,000 you just gave to Uncle Sam. In your HSA, the government never touches it. Now let's talk about tax advantage number 3, and this is where the magic really happens. Once you hit retirement age, that's 65 officially, you can withdraw money from your HSA for any reason, penalty-free. You'll pay income tax on non-medical withdrawals, but here's the thing, you're probably in a lower tax bracket in retirement anyway. But if you withdraw for qualified medical expenses, even at age 75, that money comes out completely tax-free. And the IRS has a very broad definition of qualified medical expenses. We're talking prescriptions, dental work, vision care, long-term care insurance premiums, mental health treatment, physical therapy, hearing aids, orthopedic devices, and yes, literally thousands of other things. Most people will have $100,000 in qualified medical expenses over their lifetime. That's $100,000 that comes out of your HSA tax-free, while the growth and contributions were already deducted. Now let me show you the strategic move that separates the amateurs from the pros. You do not have to withdraw from your HSA in the year you incur the expense. You can keep those receipts, you can let the money grow for decades, and then in retirement you pull out funds for those old expenses. So here's the actual strategy. 1. Max out your HSA contribution, $4,150 or $8,300. 2. Pay your medical expenses out of your personal checking account. 3. Keep meticulous records of every qualified expense. 4. Invest the HSA funds aggressively while you're young, then dial back risk as you age. 5. In retirement, withdraw against your historical medical expenses tax-free. This is literally a tax-advantaged account where you get the deduction when you contribute, tax-free growth while it sits, and tax-free withdrawals when you need it. I'm going to repeat that because it's important. Deduction, growth, withdrawals, all tax-free. You cannot do this anywhere else. Now let me tell you the mistakes that cost people thousands. Mistake number 1, not investing the funds. If your HSA is sitting in a savings account earning 0.5%, you're leaving 6.5% on the table every single year. Over 30 years, that's the difference between $215,000 and $597,000. That's real money. Mistake number 2, using the HSA for every medical expense the year you incur it. You're missing the whole point. You want this thing to grow. Let your taxable income pay for medical expenses while your HSA compounds. Mistake number 3, mixing this strategy with poor overall tax planning. Your HSA should be part of an integrated strategy with your business structure, retirement accounts, and charitable giving. One strategy doesn't exist in isolation. Let me give you actual numbers so you understand the impact. Let's say you're a 40-year-old business owner, $150,000 annual income, 32% tax bracket, and you've been neglecting your HSA. Starting today, you max out at $4,150 per year for 25 years until retirement. You invest conservatively at 6% returns. Your account grows to $186,000. That $186,000 cost you only $4,150 times 25 equals $103,750 out of pocket. The rest, pure growth, compounded tax-free. The tax savings on those contributions alone, $1,328 per year, 25 years equals $33,200 in direct tax deductions. Then in retirement, you withdraw $20,000 per year for qualified medical expenses, which is realistic. Over 20 years of retirement, that's $400,000 withdrawn completely tax-free. In a taxable brokerage account, you'd pay capital gains tax on a significant portion of that withdrawal. We're talking about $50,000 in additional taxes you just avoided in this single account. And that's being conservative. Here's what separates people who use this strategy from those who don't. One group retires with an extra $200,000, $500,000 sitting in a tax-advantaged account. The other group, they never even considered it. Now, I want to be clear. This only works if you have an HSA-eligible health plan. You cannot use an HSA if you have comprehensive healthcare coverage through a regular PPO or HMO that doesn't qualify. But if you're self-employed, own an LLC, or work for a company that offers HSA-eligible plans, you're literally leaving free money on the table if you're not maxing this out. The beauty of this is that it stacks on top of everything else. You can still max out a solo 401k. You can still do a backdoor Roth. You can still optimize your business structure. The HSA is just one layer of a comprehensive tax strategy. But here's what most people do. They hear about HSAs, they think, oh, it's for medical stuff, and they move on. They don't realize they're leaving $150,000 on the table. They don't realize their HSA can be a stealth retirement account more powerful than their 401k. They don't realize that with 3 separate tax advantages stacked together, this is literally the most tax-efficient account in the entire U.S. tax code. Don't be that person. Start today. Open an HSA if you don't have one. Max it out, invest the funds,